Bitcoin and mainstream payments in 2026. Imagine it's late 2026. You're buying coffee. You don't use Bitcoin like it's a special event. You just pay. No drama, no crypto bro moment, no lecture to your friends. And here's the twist. The payment might be Bitcoin. Without you even holding Bitcoin, it might run on a Bitcoin rail, while you see pounds, euros, or dollars on the screen. That's the story of 2026. Because the biggest Bitcoin payment revolution isn't everyone spends BTC. It's that Bitcoin quietly becomes a payment highway in the background, while stablecoins, wallets, and regulators decide how mainstream it can get. Today, we're going to make predictions for 2026, grounded in what's already happening right now with PayPal, Cash App, the Lightning Network, banks, and new regulation across the UK and Europe. By the end, you'll know what mainstream Bitcoin payments will actually look like in 2026. Who wins, Bitcoin rails, stablecoins, or cards? What could derail it? Volatility, taxes, and regulation. And the one metric that matters more than price. What mainstream payments really means? When most people hear Bitcoin payments, they picture a world where salaries are paid in BTC, and everyone buys groceries with it daily. But mainstream payments don't work like ideology. They work like infrastructure. In 2026, mainstream won't mean everyone chooses Bitcoin. It'll mean Bitcoin is embedded into systems people already use. Wallets that look like normal banking apps, checkout buttons that look like normal checkout buttons, and rails that settle fast and cheap, especially cross-border. And crucially, it'll mean compliance. Because the moment crypto touches mass adoption, it touches regulation. Europe already moved with MiCA, creating EU-wide rules for crypto assets and stablecoins. The UK's FCA is actively building its regime, and even publicly called stablecoin payments a priority for 2026, while also moving toward a full crypto regulatory framework. So, 2026 is not Wild West crypto. It's crypto inside a cage, and the cage is what allows it to scale. The 2026 payment battlefield, 3 rails fighting for your checkout. 1. Card networks plus bank rails. 2. Stablecoins. 3. Bitcoin Lightning plus Bitcoin-backed routing. In 2026, you'll see 3 systems competing. The card empires, Visa, MasterCard plus banks, they already dominate. They're trusted, they have consumer protections. But cross-border costs can be ugly, settlement can be slow behind the scenes, and merchants hate fees. Stablecoins, the dollar on-chain model. Stablecoins are designed for price stability and fast transfer, and the biggest mainstream signals are coming from the establishment. Visa has been pushing stablecoin settlement and integration, and reported expansion of stablecoin settlement capabilities for banks. MasterCard has also partnered in stablecoin initiatives, like promoting a new stablecoin with Fiserv. And even major banks are investing in stablecoin settlement infrastructure, like Barclays investing in a stablecoin clearing startup. Bitcoin payments, mostly via Lightning. Bitcoin's base layer is secure, but for everyday payments, the action is in layer 2, especially Lightning. Lightning aims to make Bitcoin transactions instant and low cost, more like tapping a card than waiting on confirmations. Now here's where it gets spicy. In late 2025, Cash App announced Lightning-based payment features that let eligible customers pay quickly, and even introduced a concept where you can pay a Lightning invoice using your USD balance without spending Bitcoin directly. That's not a small detail. That's basically Bitcoin Rail, fiat user experience. And that's a preview of 2026. My first prediction. In 2026, Bitcoin payments will grow fastest when the user doesn't feel like they're using Bitcoin. This is the invisible rail model. Here's how it works. A customer has pounds, dollars, euros in an app. They scan a Lightning QR code at checkout. The app routes value using Bitcoin Lightning behind the scenes. Merchant receives local currency or stablecoin. Customer experiences instant pay. Cash App's announcements around Lightning payments and the option to pay Lightning invoices using USD balance are basically a blueprint for that approach. This matters because the biggest barriers to spending BTC are volatility, anxiety. Tax complexity. In many places, spending is a taxable event. And the psychological pain of, I spent something that could go up. So, the mainstream move is not everyone becomes a Bitcoin spender. It's Bitcoin becomes the rail while people think in fiat. That's how mainstream adoption actually happens. If you want a signal of what mainstream companies think, look at PayPal. PayPal publicly pushed Pay with Crypto as a merchant tool aimed at near-instant settlement and cross-border efficiency, and framed it as bringing crypto payments more mainstream. Now, here's the prediction. In 2026, big consumer apps will offer Pay with Crypto more often, but the default winners inside those systems will usually be stablecoins or instant conversion. Why? Because merchants hate volatility, and consumers hate uncertainty at checkout. So the mainstream pattern becomes, you pay with crypto. The system converts instantly. Merchant settles in something stable. And that's not anti-Bitcoin. It's just reality. Bitcoin can still be the rail, the reserve asset, the store of value. But stablecoins are optimized for, I need to pay right now. Even regulators are leaning hard into this. The UK FCA explicitly highlighting stablecoin payments as a priority for 2026 is a major signal of which Rails institutions want to standardize. In the EU, MyCA builds specific regimes for stablecoins and crypto service providers, which will push regulated mainstream toward compliant stablecoin structures. So in 2026, Bitcoin expands payment reach. But stablecoins likely become the everyday, spendable layer inside major platforms. Lightning's biggest wins are not always in London, New York, or Paris. Lightning shines when card fees are too high, chargebacks are a nightmare, cross-border settlement is slow, or banking access is limited. In 2026, Lightning will grow most in cross-border commerce, remittances, creator payments, and high-fee merchant categories. Think online creators getting paid globally, small exporters, digital services, travel regions where card acceptance is patchy, places where people already use QR payments. And the mainstream signal won't be, Lightning is cool. It will be, it's cheaper and it works. 2026 is when the payment war stops being only tech and becomes governance. In the EU, MyCA is the framework that makes crypto services licensable and enforceable across the bloc. In the UK, the FCA is actively building a new crypto asset regime, expected to come into force later, but the consultation and pathway is already public. And there's a deeper layer, reporting and surveillance. Tax authorities worldwide are moving towards stronger reporting frameworks for crypto activity. This shapes payments because if spending becomes heavily reportable and taxable, many people won't bother. That's why the invisible rail model is so powerful. The user experiences a normal payment while the system handles compliance. Mainstream Bitcoin payments in 2026 will expand most in jurisdictions where compliance is clear and the UX hides complexity. Where rules are unclear or harsh, adoption stagnates. Let's be blunt. Most banks don't wake up thinking, how do we make Bitcoin win? They wake up thinking, how do we reduce settlement cost, compete with fintech, and stay within regulation? That's why the most aggressive institutional push is often around stablecoins and tokenized settlement. Barclays investing in stablecoin settlement infrastructure is a clear sign that big banks are positioning for a future where digital money clears across networks, and major payment networks moving stablecoin settlement forward suggests 2026 will be a breakout year for regulated stablecoin rails. In 2026, the bank-friendly version of mainstream crypto payments will be stablecoins and tokenized settlement, while Bitcoin benefits indirectly as the reserve asset and as a rail in certain ecosystems. Bitcoin's mainstream role becomes collateral, treasury reserve, settlement option, and a censorship-resistant fallback. Not your bank account is BTC. Not yet. Now let's talk about what could break the narrative. A major compliance crackdown or travel rule friction. The more identity and reporting requirements tighten, the more casual users avoid direct crypto spending and stick to normal rails. Volatility returns at the worst possible moment. If Bitcoin swings hard during a period of mainstream merchant rollout, merchants will push back and prefer stablecoin settlement only. Security incidents and scams. If the public associates crypto payments with fraud headlines, mainstream adoption slows, even if the tech works. Political and regulatory fragmentation. The ECB has publicly warned about safeguards around foreign stablecoins and systemic risks, signals of how seriously policymakers take this issue. That kind of tension can create patchwork rules, slowing cross-border scaling. So yes, 2026 can be a breakout year. But it can also be a year where mainstream adoption becomes more controlled, more permissioned, and more regulated than early adopters ever wanted. Everyone watches price. But mainstream payments are not a price story. They're a usage story. Here's the metric that matters most in 2026. How many normal people used a crypto rail this month without thinking about it? Not how many people bought BTC. Not how many tweeted about it. Actual payments, actual settlement, actual repeat behavior. That includes Lightning routed behind the scenes, stablecoins used for remittances, merchants settling in regulated digital money, and apps that mask complexity. Cash apps move toward Lightning payments and consumer-friendly flows is exactly the kind of product shift that can drive that metric. PayPal pushing crypto payment tools to merchants is another. And if Visa-style stablecoin settlement expands into broader rollout in 2026, that's another major accelerator. Let's lock in the 2026 predictions. 1. Invisible Bitcoin wins. The Bitcoin rail grows fastest when users pay in fiat UI and the system routes value in the background. 2. Checkout normalizes crypto via big platforms, but stablecoins and instant conversion dominate merchant preference. 3. Lightning grows where cards are weak. Cross-border, high fees, creator economy, and remittances. 4. Regulation becomes the adoption gate. MyCA in the EU and FCA frameworks in the UK shape who can scale legally. 5. Banks push tokenized settlement, not Bitcoin ideology, but Bitcoin benefits indirectly as collateral, reserve, and optional rail. And the biggest conclusion of all, in 2026, mainstream payments won't look like a revolution. They'll look like an update, a normal checkout, a normal receipt, a normal app. But underneath, the rails are changing. So here's the question I want you to answer in the comments. Do you think mainstream payments in 2026 will be dominated by stablecoins, by Bitcoin rails like Lightning, or by the old system absorbing everything and staying in control? And if you want the follow-up video, I'll make it next. The cashless trap versus crypto freedom. Who wins in 2026? Like, subscribe, comment, 2026 if you want. Part 2, stay awake, stay aware. This is Felix. See you in the next one.